Okay, so now let's move to the balance sheet. While profit and loss statement tell us how much profit the company earns during a financial year, the balance sheet tells us the company's financial position at a particular point in time. So, in simple terms, it answers two very important questions. First, where has the company obtained its money from? And second, where has the money been invested? That's why the balance sheet is divided into two major sections. On the left, we have equity and liabilities, which represents the source of funds. On the right, we have assets, which represents the use of or applications of those funds. Now, one of the most important accounting principles is that the total sources must always equal to the total uses. That's exactly what we'll verify at the end of this sheet. So, equity and liabilities. Now, let's begin with share capital. Share capital represents the money invested by owners or shareholders of the company. So, the company starts with 12 crores of equity capital. You'll notice that this value remains constant throughout the forecast years. That simply means that the company is not issuing any new shares and is not buying back existing shares. The ownership structure remains unchanged throughout the forecast period. The formula we have used here is, as you can see, assumptions. Dollars assumption C39. So we go in the assumptions page and we have C39. 39 is this. Okay. So yeah. Hmm. So rather than typing the number manually, the balance sheet automatically pulls the opening share capital from assumptions. Moving on to reserve and surplus. Now we have reserves and surplus, also known as retained earnings. So whenever a company earns profit, it has two options. It can distribute part of the profit to shareholders as dividends, or it can retain the remaining profit with the business. The retained profit accumulates years after years and appears under reserves and surplus. Now, in our model, retained earning increased from 41 crores to 58 crores to 77 crores. This this increase kind of indicates the company is constantly profitable and is reinvesting a significant portion of its earning back into the business. The formula that we use is assumption C40 plus P&L projections C16 into 1 minus assumption C52. So this formula takes the opening reserves from the assumption sheet, then it adds the current year's profit after tax. However, not all profit is retained. So the model subtracts the dividend payout percentage because the portion is distributed to shareholders. Only the remaining profit is added to the retained earnings. Okay. Moving on to total shareholder fund. A total shareholder fund represents a company's total equity. It's simply the sum of share capital and retained earnings. This tells us how much the company's assets are financed by its owner rather than lenders. As retained earnings continue to grow every year, stakeholders' equity also becomes stronger. So we have used the formula C7 plus C8, that is C7 and C8. Okay. A very straightforward calculation indeed. It simply combines the owner initial investment with all accumulated retained profit. So then there's long-term debt. This include term loans, bank borrowing, or debentures that the company has to repay over several years. In our forecast, long-term debt gradually decreases from 16 crores to 13 crores and finally 10 crores. This tells us that the company is repaying its loan over time instead of taking on additional debt. From a financial health perspective, this is a positive sign because lower debt generally means lower interest, cost, and lower financial risk. So yeah, debt is getting lowered, so that's good. Now, here we are using the formula assumptions C41 plus assumption C49. Okay. So let's see what is assumption C41 and C49 so that you get a clear idea. C41 is opening long-term debt and C49 is debt change year. That is the repay year. Okay. I hope it's clear. Now we calculate the total sources. Now this represents the total funds available to the company. So these funds come from two places. First is shareholder through equity and retained earnings, and lender through long-term debt. This total amount must exactly equal the total assets of the company. The formula we are using here is C9 plus C10. That's total shareholder fund plus long-term debt. And that's how we are getting it here. And yeah, I think it's going great, I think, for company. So perfect. Now let's move to the asset side. Property, plant, and equipment, often called as PPE. Okay. What is called PPE? Property, plant, and equipment. Now, PPE includes long-term productive assets such as manufacturing plants, machinery, factory, buildings, and equipment. This is one of the most important assets for manufacturing company because these assets generate future production and revenue. Notice that the net block increases from 33 crores to 39 crores. This indicates that company continues investing in new machinery through capital expenditure. So, as you can see, the formula which we have used is assumptions C30 plus assumptions C25 minus P&L projections C11. So yeah, that's what we have used to get the PPE. So it begins with opening the fixed assets, adds new capital expenditure made during the year. Then it subtracts depreciation because depreciation reduces the book value of assets over time. Okay, I hope it's clear. Moving on to trade receivables, also known as debtor, represents money customers still owe to company after sales have already been made. So as revenue increases, receivables also increase because more sales are happening on credit. This is perfectly normal for a growing manufacturing business. Now, receivable, the formula that we have used is again assumptions into PLN projections, CX divided by assumptions C8. So this formula scales receivables based on revenue growth. As sale increase, receivables grow proportionally. So you can see the sale of the company is gradually increasing year by year. Moving on to inventories. Inventory includes raw materials, work in progress, and finished goods waiting to be sold. So as production increases, inventory also increases because the company needs to maintain sufficient stock to support future sales. So inventory percent into revenue, we are using assumptions into P&L projections C6 and assumption C. So this follows the same logic as receivables. Higher revenue requires higher inventory. Okay, that's why we have to put in the money in the inventory to have higher revenue. Moving on to trade payables. Trade payables represents the money the company owes to its suppliers. So instead of paying that immediately, businesses usually receive a credit period. As purchases increase with business growth, supplier payables also increases. Same, we have used assumptions into P&L projections divided by assumptions C8. Okay. So what is assumption C45, C6 and C8? So C45 assumptions, as you can see, is opening creditors. C6 assumption is it C6? Sorry, it's PNL C6. The PNL C6 is revenue from operations. That's the total revenue. So 8 crores into is 8 crores. Yes, 8 crores into 115 crores and yeah, divided by the assumption C8. So here it is C8. That is 100 crores. So yeah, we get 9 crore trade payables. Okay, I hope it's clear. Okay, moving on to networking capitals. So, working capital represents the amount of money required to run day-to-day business operations. It's calculated as receivables plus inventory minus payables. A growing company generally requires more working capital because more cash gets tied up in inventory and customer receivables. So, yeah, receivables plus inventory minus payables, C15 plus C16 minus C17. Perfect. As you can see, cash is the most liquid asset available to the company. The figure is not manually entered. Instead, it is automatically linked to cash flow statement. That's why in the formulas we can see the cash flow C28. This demonstrates one of the key principles of the three-statement financial modeling. The balance sheet, profit and loss statement, and cash flow statements are fully interconnected. So, total uses are this represents the total value of all company assets. It includes fixed assets, working capital, and cash. So every rupee raised by the business must ultimately appear somewhere within these assets. So formula, as you can see, is PPE plus net working capital plus cash. That is C14 plus C18 plus C19. That is 33 crores plus 18 crores plus 18 crores. That's is around 69 crores. Okay, perfect. Uh, Works perfect. So variance formula, as you can see. So this final section is one of the most important validations to check in financial modeling. A balance sheet must always satisfy the accounting equation. Assets must equal equity plus liabilities. So to verify this, the model calculates the difference between total sources and total uses. Okay, so yeah, I think it's good enough. Now moving on to variance. What is variance? It's total sources minus total uses. If the result is zero, it means that every financial statement is correctly linked and model is internally consistent. Now the formula here is C11 minus C20, that is C11 is total sources minus C20 is total uses. Total sources minus total uses. Okay, perfect. So as you can see in the tie status formula, we have used the if statement. So this if statement automatically checks whether the variance is effectively zero. If the difference is less than 1 paisa, then the model displays balanced. Otherwise, it immediately highlights that the balance sheet is out of balance. This is considered one of the most important quality checks in professional financial models because it instantly identifies broken formulas or missing links. So, to summarize, the balance sheet tells a very clear financial story. Over the 3 years forecast, Arvanta India continues to grow its asset base through capital investments, increases its working capital to support higher sales, and generate stronger cash balances from operations. At the same time, the company steadily repays long-term debt while retaining earnings continuing to grow because of consistent profitability. Most importantly, the balance sheet remains perfectly balanced across all 3 years, confirming that model follows a fundamental accounting equation and that all three financial statements are correctly linked. This is one of the strongest indicators of a reliable and professionally built financial forecasting model. So I hope you learned something from this. Thank you so much for watching.